How is everybody doing tonight? It is Friday night, and you are here live in the strategy room with the banker next door. It is great to be here. It was a giant week. Some might say huge week. Uh, that's why I'm already starting with my cheesy jokes here as the night has begun. All right, so we got a lot to cover here tonight. Obviously, the political ramifications of Trump winning. Republicans taking the Senate, looking like they're going to take the House. And what does that mean? We're going to take a look at that. Specifically, what does it mean for banking? What does it mean for the banking industry? How is this going to affect a number of, kind of hot button regulations that are sitting around out there right now? So we're going to take a look at all that. Obviously, the other big news of the week, the Federal Reserve cutting the interest rates by 25 basis points yesterday. Jeremy Powell had some very, very fascinating comments in the press conference afterwards in terms of, whether or not, the president has any authority to make him leave or fire him or whatever the case may be. But so we'll get into all that in a little while. We'll talk about the Fed's decision, some comments on that, just some thoughts that I have in general. So we get into all that. I have a lot of other banking news. Bitcoin hit all-time high. It was, set over 76,000. It hit this week, which was pretty amazing. We're going to take a look at like the 10-year Treasury, like what's going on with that. Why is that continuing to go up? And I'm going to show you some bond related information as to why that is and why that's going on. We're going to talk a little bit about open banking as well. So we're going to get into, I want to talk, but we're going to focus specifically tonight on APIs, the API aspect of open banking, because it's through the APIs that companies will be able to hook up to the supposed portal that banks are supposed to build. And the question is, well, how safe are APIs? So we're gonna talk about that a little bit later as well. A lot of just general banking news, some very interesting banking news, I might add, that I'll have to share with you guys in a minute. But first, I'll tell you what, let's go into before we get into the economic indicators and some of the things that came out this week, let's talk about what's going to be coming up this following week. So obviously we have off on Monday for Veterans Day. And so the market will be closed on Monday, and then we go into Tuesday, Wednesday, Thursday, Friday. So on Tuesday, November 12th, we get the OPEC monthly report, and then we also get consumer inflation expectations. On Wednesday, November 13th, we're going to get the core CPI. We're also going to get the federal budget balance. We're going to get API weekly crude stock. Thursday is going to be a pretty good day because we're going to get continuing jobless claims, initial jobless claims. We're going to get PPI, and then the Fed chair, Jeremy Powell, he's going to come out and speak at 3 o'clock. On Friday, the 15th, we're going to get core retail sales, regular retail sales. The market, they love their retail sales. Get a good retail sales number cures all ills, right? Industrial production, business inventories, and then really big, we get the Atlanta Fed, the GDP now for the fourth quarter at 1 o'clock on Friday. So that'll be big. We've got definitely some big inflation information with the CPI and the PPI coming out. We got Jeremy Powell speaking on Thursday. And then on Friday, we got retail sales in the Atlanta Fed GDP now. So it will be a very busy week next week in terms of economic indicators and information coming out. So we'll see what comes with that. So now I just want to touch on briefly here what the episodes that I had that came out last week. So for anybody that did not get a chance, so last week I did the normal live stream on Friday night, but then on Saturday night I actually did a special I did a strategy room crypto series special on last Saturday night, and I covered a broad range of basically reports. I had over 6 different reports in there, a couple from the biz, a couple from the Financial Stability Board. We looked at a number of different issues, tokenization. We looked at central bank digital currency. We looked at different cryptocurrencies. We talked about stable coins. So we talked about a whole bunch of different things that were going on, and I just felt it was better And that ran for about an hour and a half. And I just felt it was better to put it together in that format. I was going to break that down into probably like 4 or 5, individual episodes, probably, like 10, 20 minutes in length. But it was so much information, and it was a lot of stuff that had just come out over the last couple of weeks. And I just felt like I didn't want to wait too long. Like I didn't want to stretch that out over 3, 4 weeks. Because of how relative the information was at the moment. So like I said, I just decided to do that as a crypto series special. So if you did not get a chance to see that last Saturday, check that out. So far, a lot of the comments I'm getting back, people really liked that and found it to be very interesting. So, and then I had a bunch of regular episodes this week. So I posted up episode 259, which was, will real-time payments lead to faster fraud? And it's a very interesting issue because a lot of people, a lot of consumers out there right now, they want faster payments. Like they love Venmo, they love Cash App, they love Zelle, and they want to be able to send things instantaneously. But the only problem is, if you send things incorrectly, or if somebody gets a hold of your phone or your online account or something, and then they start sending the payments instantly, so you get payments instantly, but then you can also get fraud instantly. So I just kind of looked at and discussed that topic a little bit, some things that you could do to try to prevent a fraudulent situation from happening to you. Then I did episode 260, which was how worried are banks about interest rate risk? And I basically looked at the OCC puts out a semi-annual interest rate risk statistics, which they get from all of the audits that they do of X number of banks under their purview, so to speak. So, and basically what we end up with is a lot of, kind of sensitivity analysis, a lot, basically looking at, well, how would banks' earnings be affected based on how interest rates go up and down? And so, we looked at some interesting information with that. Then we had episode 261, which is, how is the CSBS feeling about the banking industry? So the CSBS is the Conference of State Banking Supervisors. That's a long name. A lot of people who, again, aren't familiar with banking, they're not real familiar with what the CSBS is. But so I say it very simply: every state has a state banking regulator, and basically those guys all get together as the conference, thus the Conference of State Banking Regulators, basically, and once a year they put out kind of an annual report about community banks. So basically, how are community banks doing? I think it is a fantastic report. It usually has some great data in there. It usually talks about how are community banks feeling about the economy, how are they dealing with a ton of different aspects, whether it's technology, whether it's the employees, the cost of labor, cost of other expenses going up, cybersecurity. They cover a lot of really good issues in that survey. So like I said, so check that episode out when you get a second. Episode 262 was, the fintech bank partnership is on the rocks. What can banks do? So what I went over in that episode was, there was basically 3 interrelated articles basically on, managing that fintech partner. How does a bank pick a good fintech partner? And, once you're in that relationship, how do you continue to make it good? And then if that relationship goes bad, how are you going to get out of it? How are you getting out of that relationship? Because those, for people who don't know, as a bank, when you sign up a fintech partner, those contracts can be very sticky, meaning they're usually for a decent period of time, usually like 5 to 10 years. They could be extremely expensive, and they have they can have prepayment penalties. They can have, termination clauses, things of that nature that can get very expensive for banks to get out of these relationships. And so there was a number of great article in there that basically said, hey, here's a number of steps that you can do to try to minimize the negative downside if you do have to get out of one of these relationships. So I think it was a great thing to look at. But the reason why that all came about, or why those articles came about, is because of there was a company called Synapse Financial Technologies, which failed earlier this year. And they were a fintech that basically had what was called the BAAS model, which is banking as a service model. They offered a number of different products to hundreds of banks and credit unions across the country, and as well as other fintechs too, like Chime, for example. And they blew up. $85 million went missing. A lot of people are still kind of blowing in the wind, so to speak, not sure if they're going to get their money back. And so this has brought a lot of regulatory scrutiny from regulators, basically saying to banks, you have to do a better job of managing the, kind of bank fintech partnership, or vendors, if you will. So that's what we got into with that episode. And I thought there was some really good information in there. And then finally, I did episode 263 was what is extend and pretend. And that was really good because I had this, the New York Federal Reserve Bank just came out with an updated report called Extend and Pretend. And it really talks about what are banks doing in their loan portfolios, particularly as it relates to commercial real estate. And so banks have been doing what's called Extend and Pretend. And basically what that's a fancy term for basically means they're pushing their loans off. So in other words, a loan comes up for maturity and they're not renewing it. They're just pushing it off. They're saying, hey, we're going to wait. And the reason why they're pushing it off is because of interest rates. Interest rates have gone up. It's made it very expensive to what we call in the industry rolling the debt, to try to roll the debt over. And so banks have been pushing off loans in their loan portfolios in the hope that interest rates begin to come down, and then that kind of bails them out because that makes it easier to refinance some of this debt. It's a little bit easier on the borrower, and it kind of keeps things rolling. But what we learn in that report is that in doing the extend and pretend to the extent that they have, banks have created what they call the maturity wall. And the maturity wall is going to hit next year. It's going to hit 25, 26, and then peak in 27. And the question becomes, well, what do banks do in this period? And we have now starting right now, we've basically hit an inflection point where banks cannot, they've extended and pretended for basically the last year and a half. And it's like they can't really go any further. They're going to have to start renewing this stuff. Now, and here's the thing that we'll get into in a minute here with the Federal Reserve. So the Federal Reserve did decrease interest rates by 25 basis points, which was great. They've decreased by 75 basis points over the last couple of months. So that is now going to begin to help as they continue to decrease a little bit more. That will help with the whole extend and pretend issue, but it's still something that's out there that is it's big. It's a big deal for the banking industry. And how are banks going to deal with this? And how are banks going to, try to thread the needle, so to speak, in getting this done so that they don't see a whole bunch of delinquency in their loan portfolio or non-performing loans. So, okay. Let's keep things rolling here for a minute. I want to get into some news here. So, okay, let's get into some private. So I just did an episode on private credit, the rise of private credit. So let's talk about some things here with this for a minute. So State Street Global Advisors filed an application with the U.S. Securities and Exchange Commission seeking permission to create mutual funds as a share class of its exchange-traded funds, or ETFs, which would be specifically designed for and only available to investors purchasing through a retirement plan. So if anybody saw the episode that I did on private credit, I basically explained that I thought that this is the next giant risky thing that Wall Street is doing, and they want to push this off on retail investors. Now, it looks like they're trying to pawn this off on mom and pop, and they want to get into retirement plans. Meanwhile, the SEC is set to review 3 recent filings for private credit ETFs, which includes a proposed partnership between Apollo Global Management and State Street Corp. Bloomberg News reported securities law experts believe that the insufficient information regarding how retail investors can easily withdraw funds containing illiquid assets is likely to attract scrutiny. Yes, I would say so. I said from the beginning, I said, why? So basically what is happening here? So the private credit industry, that is something that got blown up because of what the Federal Reserve did for so many years after the financial crisis, keeping rates at zero, caused, hedge funds, private equity, it caused them to what we call reach for yield. So they were reaching for yield. So they were trying to find ways to make money. And the private credit thing was an interesting thing. And there's two ways of offering private credit. You either buy loans from banks. So in other words, JP Morgan says, oh, hey, we got some risky loans over here. We want to get rid of them. So a hedge fund or a private equity would say, hey, all right, we're going to start a private credit unit. And we're going to go out and we're going to just buy some loans, and we'll hold those loans on our books. And we'll probably make that customer pay a little bit higher interest rate, charge them some fees, and we'll make a little bit money. But it was a great way for them to make an easy 4 or 5% when rates were at zero. That's the key thing there, when rates were at zero. The other way to do private credit is just to make the loans yourselves. And they did some of that too. They did a little bit of private lending where, a bank didn't want to make the loan, but somebody comes into the private equity or the hedge fund. So they decide, hey, yeah, we're fine. We'll make the loan. And instead of doing the bank rate at 5%, we'll give it to you at 7 or 8, and they said, okay, fine. Cause it was either that or you don't get the loan. So, so that's what kind of spurred the creation of the private credit market. But as this beast, as I call it, has grown over the last few years, what they've turned to now is that with interest rates going up, now all of a sudden, a lot of the big banks have some loans that they think are pretty rocky on their balance sheet, so they sell those loans off to the private credit segment. In other words, hedge funds and private equity. And I asked the question, why would they buy these loans? Why would they do this? Because they know these loans are very risky, and they know that a good percentage of these loans are going to blow up at some point. So why would they do this? And part of the reason was they had this business line, and they have to feed the business line. So they got to continue pumping loans into it. So that was part of it. But the bigger thing now is that you realize that they now sit there and go, oh man, we've got a lot of these loans on our books that are very risky and are probably going to go bad. So now we need to now it's time to pass the buck. Now it's time we need to pass this off to the retail investors, suckers. Retail investors. Oh wait, did I say that? Couldn't have said that. Anyway, so that's why I would be very, very, very leery of this. You see these ETFs come out. I would be highly cautious of ever investing in any of this stuff. So, okay. Washington, D.C. based investment firm Liberty Strategic Capital is seeking to increase its ownership stake in New York based Flagstar Financial. And if anybody's not aware, so New York Community Bank, which had a lot of trouble last year, which, went through a change of leadership, board members raised $1 billion in capital. So they changed their name officially to Flagstar Financial because that's the name of their underlying bank that they own is Flagstar Bank. So they changed their name from New York Community Bank to Flagstar Financial. So I digress, but I just wanted you to understand who we were talking about there. So American Banker reported, citing an August 23rd regulatory filing attained by the news outlet, should the Fed accept the proposal, Liberty founder and former Treasury Secretary Steve Mnuchin, through his position at the company and at a number of other entities, would indirectly control up to 22.9% of voting securities at the bank. So very interesting. So Steve Mnuchin trying to basically get more control over the bank there. So German lenders are reducing their exposure to legacy U.S. office loans due to concerns over potential commercial real estate losses, which caused declines in bond and equity prices in February. Yes, so I've got an article on this that I'm going to share with you guys a little bit later. So it is very interesting what's going on in Europe. It's interesting from the perspective of the European banks bought or have mortgages on a lot of U.S. commercial real estate, and that's the issue. Which is it's interesting because you've seen a lot of buildings, particularly office buildings, that have gone delinquent here over the last year, and you're kind of saying, well, why aren't we seeing this hit more banks? And it is hitting the banks. It's just not U.S. banks. It's hitting banks over in Europe that actually lent money on these things. So it's like I said. So it's kind of interesting. Not necessarily what you would think. The soap opera that is B. Riley Financial. I got to do an episode on this whole thing one day because this is quite the crazy story. So they disclosed that they will have to record an additional impairment with respect to its equity investment in Freedom VCM Holdings, the parent of Franchise Group, and its loan to Vintage Capital Management in light of Franchise Group and its affiliates filing for Chapter 11 bankruptcy on November 3rd, according to a regulatory filing. The company expects that the non-cash impairments of the Freedom VCM investment and the Vintage Capital loan receivable will be approximately $120 million in aggregate. This is not the outcome we ever envisioned. Company CEO Bryant Riley said in an email to employees, there will likely be no equity recovery for all the constituents that participated, including the B. Riley shareholders, 69 employees, wealth clients, and institutions that rolled their shares from the public entity and new institutional shareholders that participated. So, this is kind of a crazy story. And I saw people over the last, I guess like month or so, basically saying that like, hey man, this story is this B. Riley Financial has got all kinds of funky things going on over there. They've got these investment funds they've gotten people involved with, and this basically these investment funds are all a sham, and this is all gonna blow up, and it's gonna turn into like a big fraudulent situation, and you're seeing that kind of unfold. So like I said, I'm going to dive deeper into that and see if I can get a little bit more information on that. So, okay. Here is some big news right here. The so-called basis trades in U.S. securities executed by hedge funds to capitalize on the price gaps between treasuries and futures are under scrutiny by the Financial Stability Board, Bloomberg News reported. Citing 3 people with knowledge of the matter, the FSB investigation comes as bets on one of the trades recently hits $1.15 trillion. Let me say that again. One of the recent trades hit $1.15 trillion, according to the report. Now, why is this big? This is big because if you have not seen my Lords of Easy Money series, you have to go watch that series. If you want to understand what's going on, if you want to understand how we got to today and how badly the Fed has screwed everything up, there's a reason, and we're going to get into this in a second, there's a reason why some of those people at the press conference with Jeremy Powell were asking him if he was going to be fired. Okay. And it's not because he's done a great job. It's because he's done a lousy job, and they know that there's good reason for him to be fired. But getting back to the basis trade thing for a minute, one of the things that comes out, one of the things they talk about in the Lords of Easy Money is that in 2019, the repo market, which is one of the main liquidity markets to our entire financial system, the repo market almost imploded. And the reason why it had almost imploded was because of these basis trades. The hedge funds had worked their way in, and unbeknownst to the Fed, had basically taken over the treasuries market and had loaded up with these basis trades. And another note, I did an episode on what happened with Japan. Like Japan had what was called the carry trade, which was very similar to the basis trades. Only the only difference was the basis trades here in the U.S. was doing it with U.S. treasuries and U.S. bonds, whereas in Japan the carry trade was using currency against U.S. dollar, Japanese currency versus U.S. currency. So it was a currency thing, foreign exchange thing versus a U.S. bond treasury debt thing. So, but this is huge news, because what happened ultimately back in 2019 was that, you had this huge crash in the repo market, and the Fed basically had to bail out all of these hedge funds. And they did it. And here's the kicker. They did it extremely quietly. They did it so quiet that most people don't even know that it even happened. And then this little thing happened a few months later in early of 2020 that basically washed that all away, so that nobody would ever, go back and ask a whole bunch of questions about how the repo market almost collapsed. But here we are. And the repo market has the liquidity in the repo market has dramatically fallen. And now we've got these basis trades once again rearing their ugly head. And it looks like somebody out there is making gargantuan trades, $1 trillion trades. And if they get on the wrong side of that, look out, man. look out. So that's big news. So Robinhood Markets, Kraken, and Galaxy Digital Holdings are among a consortium of financial technology and cryptocurrency companies that teamed up to launch the Global Dollar Network to increase stablecoin adoption worldwide. So, all right, we'll have to see if anything happens with that. So, all right, so what are some of the economic indicators that came out this week? What did we learn about some stuff this week? So we had factory orders dropped in September. New orders for manufactured goods decreased 0.5% in September, following a 0.8% decline in August. We have service sector index increases in October. So economic activity in the services sector increased for the fourth straight month in October. According to the Institute for Supply Management, ISM's index registered 56% in October, the highest reading since July of 2022. Wholesale inventories decreased in September. Wholesale inventories, a component of the gross domestic product, dropped 0.2% in September, but were up 0.3% from a year ago. According to the Commerce Department, sales rose 0.3% from the prior month, but were down 0.4% from a year ago. Consumer credit was up in September. Consumer credit increased 1.4% in September after rising 2.1% in August. The Federal Reserve reported revolving credit, which includes credit card spending, increased at an annual rate of 0.9%. Non-revolving credit, such as auto and student loans, increased 1.6% in the third quarter. Overall, consumer credit rose 3.2%. And then we had mortgage applications dropped by 10.8% from the previous week, the sixth consecutive decline in mortgage demand, according to the Mortgage Bankers Association. Applications for mortgage refinance loans fell by 18.5%, and applications for new mortgages declined by 5%. So what is happening there? Well, the Federal Reserve has, they're cutting back on what's called the federal funds rate. So the federal funds rate is coming down, but because of our debt situation, the U.S. Treasury rates, like the 10-year Treasury, what we call long-term Treasuries, are going up. And everything in our personal lives, whether it's mortgages, auto loans, credit card debt, student loans, it all runs off of the 10-year Treasury. So if the 10-year Treasury is going up, while the Fed is reducing their federal funds rate, not really doing a whole lot, is it? So, okay, let me just check to see if I had anything else in there. Don't think I had anything on that front. So, okay. So let's look at a couple other things here real quick before we get into the Federal Reserve stuff. So let's bring this up. So I just wanted to point this out to everybody. Maybe I'll see if I can make this a tad bit bigger here. Okay, so the ICBA made this announcement this week. They basically said that they were entering into a new era of ICBA payments. So basically said in a new Main Street Matters blog post, President and CEO Jacob Eisen said ICBA Payments has a strong foundation and serves more than 1,500 clients. But it's time to go on the innovation offensive to build, license, and bring to market payments technology, products, and services that enable community banks to compete with larger financial institutions. Eisen said ICBA Payments is not only looking at what products it can bring to the market as solutions, but also identifying those that will help community bankers automate and improve back office payment functions. And we'll be partnering with third parties to build those solutions in-house. So let's see here. Our parent association represents thousands of independent community banks. Collectively, ICBA Payments and its subsidiary agent credit card bank, TCM Bank, serve more than 1,500 clients. So in addition to our expertise and sole focus on serving community banks, we also have the benefit of group buying power. By card issuing volume, we are the 29th largest card issuing business in the U.S. Our 40 years of experience coupled with size and scale bring real value to our community bank partners. Not only do we aggregate the buying power of our nation's community banks, we also touch millions of consumers and small business owners in the payment flow. And it just kind of goes into, introducing new product-focused vision. So we're committed to putting the resources and investment in the people behind our efforts to ensure you have the best possible tools to compete in today's payments landscape. We have partnered with Pigeon to enable FedNow real-time payments for community banks via modern APIs. Ah, my favorite thing, APIs. We're also exploring the connectivity between our card issuing business and bank merchant acquiring needs on the other side of the transaction. Banks need to offer more holistic card payment solutions and ones that drive the cost of issuer funded rewards down over time. So we are evaluating best-in-class merchant-funded rewards programs, which help to directly connect to the communities you serve, increase transaction volume, all while potentially reducing issuing rewards liability. Yes, and now that I've made that pitch, ICBA, I do take check, cash, and credit for making this pitch for you. Just kidding. Okay. What else do we got here? One thing I missed. Manufacturing index contracts and construction spending edged up for the last month. So economic activity in manufacturing sector contracted in October for the 7th consecutive month. That's not good. With the Institute for Supply Management's index declining 0.7 percentage points to 46.5%. Employers added 12,000 jobs in October, and the unemployment rate was unchanged at 4.1%, according to the Labor Department. I will bet, and I can't put a dollar amount on this not live. I would be willing to bet that when we get that revision, there's a revision coming later this month, that number is going to go from 12,000 to negative. I could almost guarantee it. That's what's going to happen. Construction spending rose 0.1% in September. So we got a little bit more construction spending. Okay, so the FDIC is getting ready to unveil an online tool to promote the creation of minority banks. The FDIC announced that today it will introduce an online tool to help financial institutions, investors, and other interested groups to identify neighborhoods that could benefit from banking services. So according to the FDIC, the Minority Banking Opportunity Explorer will be presented at today's FDIC Advisory Committee on Community Banking Minority Depository Institutions Subcommittee meeting. Supports the FDIC's statutory mission to promote and encourage the creation of new minority depository institutions by assisting financial institution organizing groups with exploring potential business opportunities in areas that may meet the community served part of an MDI designation. Can support existing MDI's growth by identifying new branch locations or advertising opportunities. So I think that's pretty cool. I think that's actually a really good thing. And hopefully the FDIC can actually help out to create some minority banks around the country. I think that would actually be a great thing for the industry and for different probably a lot of inner cities, I would imagine, around the country would just be a really good thing for create some good local hometown banks that can hopefully grow in the years to come and do good things for customers, stakeholders, investors. So hopefully that's a good thing. CFPB penalized Navy Federal Credit Union for overdraft fees. So the Consumer Financial Protection Bureau ordered Navy Federal Credit Union to refund more than $80 million in overdraft fees to consumers to change its overdraft practices and pay a $15 million civil penalty. So it's kind of interesting. I had reported on TrueMark Federal Credit Union last week at about how they were the first bank in the country to ever get hit with what's called redlining. They got hit with a redlining fine for not lending in certain areas of the city of Philadelphia. And they got hit with a $6.5 million fine. And now you've got Navy Federal Credit Union getting blasted here with a $15 million civil penalty for their overdraft fees. And it's just really interesting because you don't normally see these credit unions getting nailed with these penalties from various different regulators. So it's just, like I said, it's interesting to see. And I think it adds some credence to the whole argument. Right now you've got this whole thing going on where, credit unions are basically buying banks. Banks aren't real happy about that. And it kind of adds some credence to the fact of how big credit unions have become, that they're now starting to get these very large penalties from regulators, because regulators are looking at them and going, you know what, that's not a little rinky-dink $100 million credit union. That's now a $6.5 billion credit union that's got 100 branches and is all over the place. And so it's a little, like I said, it's an interesting kind of little attitude shift there that's kind of going on. So, all right, now let's take a look. Hang on a second. I'm just going to take a sip of water here before we get into, we're going to get into the Fed stuff now. All right, so hold on. I'm going to go to the other article first. Okay. Federal Reserve cuts interest rates by a quarter point. So the Federal Open Markets Committee lowered its benchmark overnight borrowing rate by a quarter percentage point or 25 basis points to a target range of 4.5 to 4.75%. So when I talk about the federal funds rate, that's what that is. That 4.5 to 4.75%, that's the federal funds rate. That's the rate that banks use to basically borrow from the Fed. The vote was unanimous. So why is that important? That was important because last month they actually had, or I should say at the last meeting, they actually had a dissenting vote. And it was the first time, I believe, they had a dissenting vote since going back to 2010 when Thomas Honig, basically had the last dissenting vote. And again, going back to the whole Lords of Easy Money thing, if you go back to that series, you'll understand why the Fed they want everything to be unanimous. They do not like Fed presidents like Bernanke and Yellen and now Powell. They do not like dissents. They're in their regimes there at the Fed. They don't like dissenting opinion. They want everything to be unanimous. They want everything to look like everything's in lockstep. No issues. So that was a big deal. That was actually a very big deal to have a dissenting vote at the last meeting there in September. And I imagine Jeremy Powell was probably not too pleased that he had a dissenting vote and probably whipped them all into shape again to make sure there was not going to be any dissenting votes this time. So Fed officials have justified the easing mode for policy as they view supporting employment becoming at least as much of a priority as arresting inflation. So the Federal Reserve approved its second consecutive interest rate cut Thursday, moving at a less aggressive pace than before, but continuing its effort to right-size monetary policy. In a follow-up to September's big half percentage point reduction, the Federal Open Markets Committee lowered its benchmark overnight borrowing rate by a quarter percent. The rate sets what banks charge each other for overnight lending, but often influences consumer debt instruments such as mortgages, credit cards, and auto loans. Most of the time. Markets had widely expected the move, which was telegraphed both at the September meeting and in follow-up remarks from policymakers since then. The vote was unanimous, unlike the previous move that saw the first no vote from a Fed governor since 2005. That is incorrect. The last one was 2010 with Thomas Honig. This time, Governor Michelle Bowman went along with the decision. See, CNBC, they need to fact check these things. They need to fact check. Maybe they should call me. And say, hey, Dr. B, what's going on here? When was the last time a Fed governor dissented? Stocks closed positive after the meeting wrapped, and that's good. And then we had the post-meeting statement, which we'll go into in a second. But let's just take a look at this chart here for a second. So here's kind of where we're at here. You can see starting in January of where are we at here? No, December of 2008. You can see that for the better part of almost 15 years, the Fed had rates pretty much near zero. I mean, they had gotten back up to about 2.375, but then obviously pandemic hit, and then boom, we went right back to 0%, and then we shot in one of the most aggressive rate increasing cycles in the history of the Fed. We went all the way back up to the basically 5.25 to 5.5 range. And we stayed there for a little while, and now we've come back down about 75 basis points. So, and the Fed has said that they probably want to bring this back down to about 3%, 3.5%, somewhere in that range. So, we'll see, which would take us back down here to 3% from 4.5 to 4.75. So that would be about another, 175 basis points roughly. They'd come back down on that. So, which is a good amount because that'll probably get, if you think about the Wall Street Journal prime rate, which is always 3% above whatever the federal funds rate is right now. So the Wall Street Journal prime is sitting at 7.75. So if you come down another 175 basis points off of that, that gets the prime rate back down to 6%. So, not too bad. Now you're starting to get commercial rates back into that 5 to 7%, 5 to 6% range, I should say. And that's pretty good. I mean, that will, it won't, it's still not going to be as attractive as those 3.5 to 4%, rates were a few years back, but it's still very good. It'll still help people out in this market. Now, let's take a look at something for a second here. Now, let's go back to look at this other article. So 10-year Treasury yield slides as the Fed lowers interest rates. So the Treasury yield fell on Thursday as the Federal Reserve cut interest rates by a quarter point as expected. The 10-year Treasury yield traded 12 basis points lower at 4.32% after jumping over 14 basis points in the previous session. The yield on the 2-year Treasury fell 7 basis points to 4.21. Yields and prices move in opposite directions. So 1 basis point equals 0.01%. So we can look at the different rates here. So the key one being the 10-year Treasury is sitting at 4.306%. I think it bounced up a little bit more today, probably hovering in that 4.36 range. I think it was by the end of today, maybe. But it's good to see that this started to come back down a little bit. I don't think that's going to last very long. I think that was a minor adjustment on the part of the market there, because we're going to go take a look at that more in just a second. But first, I just want to read to you guys. Let's look at let's just take a look. So this is the Fed. This is their official press release. And I know this is a little hard to see. Let me see if I can blow that up a little bit. Yeah, there you go. It might be a little bit better there for everybody to get to see, so everybody's not wrecking their eyes on here. So let's just let's read this for a second here and see what the Fed said. So recent indicators suggest that economic activity has continued to expand at a solid pace. Since earlier in the year, labor market conditions have generally eased, and the unemployment rate has moved up but remains low. Inflation has made progress toward the committee's 2% objective, but remains somewhat elevated. The committee seeks to achieve a maximum employment and inflation at the rate of 2% over the long run. The committee judges that the risks to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee is attentive to the risks on both sides of its dual mandate. So isn't that kind of interesting what they say there? So on the one hand, they're saying that, like, oh yeah, we're making progress on our inflation target. Unemployment is still really strong, but we face this uncertain economic outlook. It's kind of, so that you can see, they're, the Fed is kind of playing both sides there. They don't want to say the economy's in the toilet, but they also, don't want to say, oh, well, things are as peachy as what the headline numbers are suggesting. The economic outlook is uncertain, and the committee is attentive to the risks to both sides of its dual mandate. In support of its goals, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So there you have it. So basically, they're saying we're going to continue to monitor the data, and we're going to continue to move along with our plans of continuing to reduce interest rates. But I have always said that the plan from the beginning is that they wanted to get it down initially. They wanted to get the rates down by 100 basis points. They're now down 75. They got one more cut to go in December. So I think they wanted to get the interest rates down by 100 basis points by the end of the year. And then they're going to take a little bit of breather over the holiday and come back in January and kind of reassess. They're going to kind of reassess where things are. Now, what we want to keep an eye on between now and January, basically from November 8th to January 8th, what we want to keep an eye on the next 2 months is, what does the 10-year Treasury do? If we see the 10-year Treasuries hovering like around 4.3%, if you see the Treasury begin to make a bolt up to 5% or maybe even hits 5% or goes higher, that's going to be a giant red flag. And that is probably going to cause the Fed to maybe definitely not to increase rates, but it could cause them to pause on further decreases until they see kind of what happens there. So like I said, I think they're definitely going to you're definitely getting another quarter point cut, but we really have to keep an eye on what the 10-year Treasury is going to do there. Now, I want to look at before we get into that, where did I have it? Hang on one second. I'm trying to. Okay, yeah, let's look at this for a second. So, deficit threat drives bond yields higher. Investors expect Trump would widen budget gap with tax cuts. So, the prospect of a rising federal budget deficit is fueling a sharp climb in bond yields, with investors betting a challenging fiscal situation will only get worse after the election. Treasury yields, which rise when bond prices fall, jumped Monday after a $69 billion government auction of 2-year notes attracted tepid demand from investors. That marked the latest leg in a weeks-long bond market sell-off that began after a run of strong economic data undercut bets on rate cuts from the Federal Reserve. The auctions aren't poised to get smaller anytime soon. When the Treasury Department releases its quarterly borrowing plans on Wednesday, it will almost certainly maintain record large debt sales over the next 3 months. There is also a chance that it could hint that further increases are coming next year, according to some analysts. Most investors expect the budget deficit to remain elevated no matter who wins in next week's elections. Well, we kind of already know that, with the cost of spending programs such as Medicare and Social Security climbing faster than federal revenue. Still, many think the budget gap will expand the most if Republicans sweep control of both the White House and Congress, leading to extensions of old tax cuts and the possible addition of new ones. Yeah, I think that remains to be seen. I think there's an awful lot of garbage. There's a lot of ridiculous spending out there right now that can easily be cut back without adding to this deficit. I think there's a lot of things that could be done to kind of at least help to not necessarily repair or fix, but to at least alleviate. I'll say it that way. I think there are a lot of things that could be done to alleviate some of this pressure here. But this goes back to what I have been talking about for months, and that is the issue with the national debt. And this gets back to why Janet Yellen needs to be fired right away, and gets into some of the comments from Jeremy Powell, which I'm going to share. So Jeremy Powell had some very interesting comments during his press conference. So what Janet Yellen has been doing over the last year or so is she has been putting, so in other words, when the U.S. government issues debt, okay, they have the government has a federal deficit, meaning that we have deficit spending, meaning we spend more money every year than we take in. And that difference basically gets put on the national debt because you have to borrow to plug the hole. Like, so in other words, if we have a $2 trillion deficit, that means we got to go put $2 trillion more on the national debt in order to fund that deficit. Now, when you do that, how do you do that? Well, you got to issue treasuries, and then those treasuries become bonds, treasury bonds. And then the government goes into, then the Treasury Department goes and sell those at auctions too. And they have auctions for all the different, if we go back, you see all the different rates here. We see the 1 month, the 3 month, 6 month, 1 year, 2 year, 10 year, 30 year. So they have treasury auctions for all these treasury bonds. And what she has been doing is she has been putting all the money into these short-term bonds, driving up the short-term price. Like you can see here that the 1 month is at almost 4.6, whereas the 10 year is at 4.3. Now that gap that's what we call an inverted yield curve. That gap was much larger just a couple months ago, and it's coming back toward, as the yield curve is reverting back to a positive territory. We're seeing that begin to shrink. But in these short-term bonds over here, this is where you are seeing all the action. Now, here's what happens. Janet Yellen has built up basically $1 trillion in these short-term bonds. And these bonds are going to have to be, the short-term bonds are eventually going to have to be rolled over into longer-term bonds. And that's what they're talking about. Like all these 1, 3, 6, 1 year, all of this has got to be rolled over into the longer, the 2, the 10, and the 20 year. All the short-term stuff's got to roll over to the longer-term stuff. And when that money rolls, okay, and this is what they were talking about. They were taking these short-term treasury bonds and they were trying to roll it into a 2 year. And what did it have? It had very tepid sales. Now, why is that? Well, a big part of the problem is that the biggest buyers of our national debt are China and Japan, and they're not buying hardly any of our national debt right now. So those sales are going to be very tepid, and this is going to cause problems as we continue to spend and spend and spend and spend, and the national debt just continues to pile up as we run these massive federal deficits every year. The federal debt is just going to continue to compound, and we have spent this year. It's only November. We still have almost 2 months left in the year. We have already spent over $1 trillion just paying for the interest on the national debt. Over $1 trillion. That's bigger than any other line item in the entire government. It's bigger. Our national defense is only like 700 or 800 billion. So it's more money than what we spend on the national defense. It's more money than Medicare and Medicaid and Social Security. It's like the biggest line item in the government is just the interest on the national debt. Interesting how none of the politicians want to talk about this, right? And what's going to happen is, this debt's going to roll into longer debt. And do you know what's going to happen to those longer term yields? They're going up. They're going up. Because what's going to happen is that if you're going to try to get China and Japan to start buying again, they're viewing this debt, this U.S. debt, as more risky. Therefore, it's the age-old concept of risk and return. They view more risk, they're going to demand more return. So that yield is absolutely going to go up. The more of this long-term debt that gets rolled in, the more pressure it's going to put on those long-term yields, and the more those yields are going to rise. And that is what's happening, and that is what is going to continue to happen. And that is why I think that there is a very real chance in the next 6 months that the Federal Reserve is going to back off from their interest rate increases, because they're going to see how this is affecting. They're going to see that the 2 year, the 10 year, the 30 year, their rates are just going to go up while the Federal Reserve is cutting down, and they're going to go, yeah, that's not working. And because what the Fed doesn't want to admit is the real problem here is they may, because of what Janet Yellen has been doing at the Treasury, it has caused the Fed to lose control of the economic situation. Now, they're never going to admit that, but this is also why Jeremy Powell was asked these questions. So the Federal Reserve Chairman, Jeremy Powell, said in a news conference that he would not resign if President-elect Donald Trump asked him to, adding that the president does not have legal authority to remove him. Asked whether he would leave if Trump asked him to, Powell replied very sternly, no, he would not leave. In response to a separate question about whether the president has the power to fire or demote him or any other Fed governor at will, he answered, not permitted under the law. In response to a question about the economic impacts of the presidential election, Powell said there is no immediate effect, and we don't guess, we don't speculate, and we don't assume. That's funny, because they've been guessing, speculating, and assuming for the last 15 years. So it's just very interesting that Jeremy Powell would make those statements in such a matter-of-fact manner, and would say that as abruptly as he does. And I suspect he is correct in that assessment. I don't know that the president has the authority to simply fire and get rid of him. Now, Janet Yellen, on the other hand, has no such protections. Okay, my guess is she's gone day one, out the door. See you later. Grandma Janet can go sit on the porch finally, and go and get to her crocheting, which she should have been doing a number of years back. I don't, you know what, I don't hate. I don't hate Janet Yellen. I think Janet Yellen is a very smart lady. What upsets me about Janet Yellen is that I feel like at some point in the last 6 years, Janet Yellen went from being a very good kind of steward, if you will, over there at the Federal Reserve, to just becoming a total and complete political hack. And I think that she is very, she plays party politics. She's very ideologically driven. She ran around in 2020 and got $7 million in speaker fees, knowing that she was going to come back into the Biden administration and either it'd probably become head of the Treasury. And so she kind of sold herself right there, and then has basically done the administration's bidding since the day she walked in the door. And that will be her legacy. That will be her legacy whenever she's done here. And like I said, and this will go sour. This will go sour. It will go south. And, at some point, she'll, of course, she'll retire and she'll write her book and she'll be doing the press tour. And then that's when all of this stuff will finally come out. That's when she'll be on 60 Minutes and she'll be getting drilled about, well, why did you do this? Why did you do that? Why did you manipulate the economy? Why did you manipulate interest rates? Why did you do all this stuff to keep us out of recession and invert the yield curve for years? Like, why did you do all that, knowing that it led to this mess thereafter? And she won't have any answers, and she'll try to play the victim and like, oh no, it wasn't me. I just, was doing what I was told, whatever, But anyway, but it's interesting because as far as I know, President Trump has not said anything about wanting to fire Jeremy Powell or get rid of him. As a matter of fact, I think he might have been asked 6 months ago, a year ago, like, hey, like, in other words, are you going to do anything with Powell? And I think he basically said, like, something to the effect of like, well, no, not really. I'll, like, kind of like, well, we'll kind of take a look at things when they come in and we'll talk or whatever. I mean, I think it would have been one thing if, if President Trump had overtly said or made, comments to the effect of like, going after Powell or threatening Powell in some way, but we haven't seen any of that, at least as far as I know. I mean, I haven't seen anything that he's even mentioned Powell and anything, even recently. So like I said, I find it curious that they would ask these questions right now. It's very interesting. Now, I will say this: if Trump comes in and decides he doesn't want Powell to be there anymore, he could ask Powell to resign. Maybe Powell says to him, well, no, I don't want to do that, and you can't force me out, whatever. The Federal Reserve needs to tread very, very lightly, because there's a lot of people, especially in Congress now, that are licking their chops at the opportunity to basically knock the Fed down a couple pegs, okay, to audit the Fed, to maybe maybe now's a great time to make some revisions to the Fed and how it's run and how it operates. So again, Jeremy Powell, yeah, maybe Trump can't force him out, but Trump could cause him a lot of problems. And if Trump really wants to, as the president, I believe he could ride him out of the job. Not that would be pleasant for either person, but like I said, I think that could happen. But like I said, I think Powell would ultimately have to step down, because he would not want major change to happen at the Fed. So in other words, he might have to fall on the sword, as they say, to not, fall upon it. So now, why am I getting into all this? I'm getting into all this because this is going to segue into what our next thing here, where we're going to talk about what does, all right, let's get out of all this. Okay, so what does all this mean, basically, for the banks. Okay, we had this changeover. President Trump is reelected. He's going to come back in for 4 more years. Republicans have taken control of the Senate. It is looking probably like 90%. I think they have secured 212 seats in the House of Representatives. They need to secure 218 to have control of the House, which is only 6 more seats. I think if they're projecting right now, they're going to win at least 220. Probably somewhere in the neighborhood of 220 to 224, something in that space. So they will take back, I believe they will take back control of the House, but it will be by a very razor thin margin. So what does that mean basically for banks? So let's take a look at a couple articles here. Key congressional races with potential to impact the banking industry. So obviously, key Senate races, we saw some of that. About 1/3 of the U.S. senators are up for re-election, including Brown, who was in a close race against Republican challenger Bernie Moreno. Brown lost. Bernie Moreno won. So we know that. So Brown will not retain his chairmanship. If Republicans take control of the Senate, ranking member Tim Scott could take the chairman's seat. So that's almost assured that will happen. Party control of the Senate could come down to the re-election of John Tester. We know John Tester lost to Tim Sheehy, so Tim Sheehy's in. JD Vance could be, would be replaced in the Senate if he's elected vice president. Well, that did happen, so he will be replaced in the Senate. In Wisconsin, Eric Hove, chairman and CEO of Sandy, Utah-based SunWest Bank, is running against Democratic Senator Tammy Baldwin. I believe Tammy Baldwin won that. So Mr. Hove does not have to worry about divesting himself of his ownership there. House committee chairmanship certain to change. So all House seats are up for re-election. It is unclear which party will take control of the chamber. We'll assume for the moment that it's going to be Republicans. So we'll say if Democrats take control, so we'll skip that. So on the Republican side, several House members are actively seeking the Financial Services Committee chairmanship, and Chip McDonald, managing director of McDonald Partners LLC, the potential leaders McDonald mentioned were Bill Huizenga, Andy Barr, and French Hill. So Huizenga is chairman of the subcommittee on oversight and investigations. Barr is chairman of the subcommittee on financial institutions and monetary policy, and Hill is vice chairman of the full committee and chairman of the subcommittee on digital assets, financial technology, and inclusion. Before joining Congress, Hill was founder, chairman, and CEO of Delta Trust and Banking Corp., which was later acquired by Simmons First National. Okay, and then let's go to the next one. And this is kind of interesting. So this says, Trump or Harris, what lenders can expect from the next administration? Let's go down here. If Trump wins. So KBW reports that stocks that could benefit from a Trump win include Capital One Financial and Discovery Financial Services because of an increased possibility of their deal being approved and lower regulatory risk. Consumer finance companies Bread Financial Holdings and Synchrony Financial also stand to benefit from a Trump win because of increased possibility of a delay or withdrawal of the Consumer Financial Protection Bureau's late fee rule, the report said. From a financial regulatory perspective, a Trump win's most immediate benefit for the financial industry would be a change in the leadership of the CFPB. CFPB director could lead to less pressure on overdraft fees and Zelle payments oversight. The JP Morgan analyst noted that the regulatory optimism under Trump would bring benefits for the whole sector, but likely more for smaller banks, which was the case in the first Trump administration. There may be a greater likelihood of M&A activity approval among small and mid-sized banks, less so for larger regional banks. Bank M&A deal approvals have taken longer under President Joe Biden's administration, as I have reported on. Yes, have taken much, much longer. But the analysts noted that the regulatory outlook can pose challenges under a Trump administration. They said more banks may face Bank Secrecy Act, anti-money laundering investigations similar to recent notices from Bank of America and Wells Fargo. Others said that the regulatory relief are maybe not so straightforward. And then if Harris wins, well, we know she didn't win. So, and then let's look at a couple other things. So U.S. Labor Department's fiduciary rule is in trouble if Trump wins. And this gets into some of the hot button regulatory things that I had been talked about in my last few episodes. So the U.S. Labor Department rule targeted so-called junk fees in some retirement investment products will likely fail to see the light of day. The final fiduciary rule announced April 21st impacts how retirement products, including certain life insurance and annuity policies, are sold by updating the definition of an investment advice fiduciary under the Employee Retirement Income Security Act. So, so this is basically in trouble and will probably go away along with a number of other things. Maybe open banking. That would be wonderful. Changing OCC CFPB has likely top bank regulatory priorities for Trump. So former U.S. President Donald Trump's victory and anticipated Republican control of the Senate and possibly the House could lead to a shakeup of some key legislative and regulatory positions affecting the banking sector. Financial stocks seem pleased overall the day after the election. Yes, you could say that with the Dow surging almost 1,500 points. Trump's choice for Treasury Secretary could come within a week or two, according to Katz. The analyst named several possibilities for this position, including Roger Lighthizer, who was U.S. Trade Representative under Trump, Senator Bill Hagerty, who was a member of the Senate Banking Committee, former Securities and Exchange Commissioner Chair Jay Clayton, Kevin Hassett, Trump's former chairman of the Council of Economic Advisors, and Trump advisor Scott Bessent, CEO and Chief Investment Officer of Key Square Capital Managements. Katz also noted that Trump advisor and Cantor Fitzgerald chairman and CEO Howard Lutnick has been reported as a potential contender. Now, so that's for Treasury Secretary. So basically, they're telling you right there that Janet Yellen she's out the door. She's gone. She's going to be gone very quickly. Bank regulators. Trump can change the CFPB and the OCC current leadership virtually right away. Those changes will switch the power of the FDIC board, even if Chairman Martin Gruenberg remains at play. Yeah, Martin Gruenberg. I've been bemoaning for months that this guy is still there. This guy will not be there. This guy will be gone very quickly afterwards, and he will be replaced along with the heads of the CFPB and the OCC. So it basically says here that there was a similar situation at the beginning of President Joe Biden's term when Trump nominated Chairman Jelena McWilliams was in the minority and eventually resigned before her term ended. To follow Gruenberg, Trump might nominate FDIC Vice Chairman Travis Hill, and Federal Reserve Governor Michelle Mickey Bowman might be nominated for either the Fed chair or controller of the currency position. Hassett could also be nominated to the Fed chair position. Fed Chairman Jeremy Powell's term is set to expire in 2026. And during the campaign, Trump said he would not reappoint him. Trump has said he would like to have some influence on monetary policy, but Katz doubts Trump will push for a quick removal of Powell. With rate cuts coming, a quarter point expected on Thursday, Trump will probably be content with the Fed's general direction. Regulators are expected to issue a new Basel III endgame proposal and probably would not finalize the long-term debt proposal, the analyst added. I would say that the Basel III endgame proposal is now dead on arrival. I would say that is going to go absolutely nowhere. And then it touches on some of the things we already talked about in one of the other articles. Let's see here. Analysts see financial stock, Trump bump on loan growth, looser regs, and M&A comeback. So equity analysts forecast broad benefits for U.S. bank and other financial industry stocks following the Republican President-elect Donald Trump's victory. The sectors that could outperform on a Trump win include financials, especially regional banks, cryptocurrency, and digital assets. A bank stock rally already kind of took off the day after. Winners under the Trump 2.0. And it could talk about, like I say, cryptocurrency stuff. Interest rate outlook under Trump. With Trump's victory, GOP control of the Senate and possibly GOP control of the House. Wells Fargo analyst Jay Bryson predicted Republicans will extend the 2017 Tax Cut and Jobs Act and that additional tax cuts are possible, according to a November 6th research note. The analyst also expects the Federal Reserve to cut the federal funds to a range of 3% to 3.25% by the end of 2025, as I had mentioned earlier. So that is all right on target. the big question, yeah, and then also see, and then this guy also noted Fitzgibbon also wrote that the yield curve is likely to steepen should Trump's economic plan lead to growth in the national debt, as the Committee for Responsible Federal Budget has projected. Yes, basically says a steepening yield curve would benefit net interest margins for most of Piper Sandler's coverage universe, but would especially be beneficial to Flagstar Financial. Yeah, but but a steepening yield curve is not going to be good for the overall economy right now. It might help banks and their margins, but yeah, it's not that's not going to be a great thing overall for the economy right now. So I think that I think the bigger thing for the Republicans and the Trump presidency to be concerned with is the national debt. Like, they've got to cut the spending. They've got to get the spending has to come down, especially if they want to cut taxes. I think you can cut taxes and you can reduce the spending at the same time, and you can kind of keep an equilibrium bound. Like, in other words, what you have to do is before you can reduce the national debt, you have to stop with the deficit spending. You got to get a balanced budget first. So I think that's step number one. I think get a balanced budget first, and then go from there and see if you can then create a plan for reducing the national debt. Now, at the same time, if you can stop adding to the national debt, and then you can begin to bring it down to even a little tiny fraction of a bit. But if the Fed reduces rates and you get the spending under control, then things will kind of even themselves out, so to speak, because then now you're paying less interest on that national debt, and you're not adding to it, so you're not compounding the problem, and now you can start to kind of massage that a little bit there. So, but what you're not going to do is you're not going to boost the economy this time by cutting rates. You're going to boost the economy by spurring growth, and you stir growth by tax cuts. Tax cuts. That's your key. You put tax cuts in there, and you're going to spur growth, because the reality is the interest rates are not, by historical standards, the interest rates are not ridiculously high. They're believe it or not, interest rates are just normal. Like, if you go back, if you look at a chart of interest rates over the last 80 years, you will see that right now where interest rates are basically at normal. They're just at normal range. They're not, it's just that the Fed perverted the market so badly over the last 15 years. And they know, like, believe me, Jeremy Powell knows how bad the Fed has messed up the market by keeping rates ridiculously. They kept rates too low for too long. They went too crazy with the quantitative easing. And now, at the end, Powell's trying to fix some of that. But the problem is, in fixing that, he would have drove the economy right into a recession and right into the toilet. But he kind of allowed Janet Yellen to manipulate things over at the Treasury to basically, make it look like that what he's doing was being effective, and that's not what has happened. So the Fed is going to be forced to reverse course, very quickly here. So, all right. U.S. bank stocks rise as Trump wins the U.S. presidential election. And then U.S. election results favor the Trump trade bets as stocks, bond yields move higher. And this basically just says, nice little bump there after the win. Steep yield rise could slow. The yield on the 10-year U.S. Treasury bond has mostly climbed since mid-September, trending with sticky inflation and expectations of an expanding government deficit that could both persist under Trump's proposed policy agenda. The post-election spike in the yield is an extension of this trend, although it may show a disconnect between Trump's campaign proposals and the eventual success of policy implementations. So, let me just say something. I want to say something on the spending. They're saying, oh, well, the deficit spending could persist under Trump. Well, maybe not. And what I mean by that is that, one of the things you have to understand, and some people probably are going to like to hear this, but it's the truth. The Democrats were just spending money. I mean, just insane spending on, and all the bills that Joe Biden put through, the so-called Inflation Reduction Act, the CHIPS Act, all this other stuff. This stuff, it didn't do anything. None of this stuff has spurred the economy. It's all just government. It's government spending that has propped the economy up to a very real degree in terms of like our GDP growth and stuff like that. And the labor market, so the labor market for the last 6 months it's been all government hiring. It's been, that's really, so, you take the government spending and the government hiring out of the economic numbers, and our GDP and the labor market would be literally in the toilet right now. We would be in a recession right now. So, so you look at that, and the point I'm trying to make with that is that the spending there on the part of the Democrats did not spur the economy. It wasn't doing anything for the economy, and made for nice headlines, but it wasn't doing anything to spur the economy. And you can cut a lot of that spending out, and a lot of that spending was on the Green New Deal climate stuff, and that stuff can all be cut. You could cut all that stuff tomorrow. You could get, that's probably $1 trillion, $1.5 trillion. And who knows how much we've been spending on the illegal immigration crisis. It's absolutely in the hundreds of billions of dollars. So, you take that out of the equation, you stop spending all the money on the welfare state and the illegal immigrants, and boom, you could bring that spending back down real quick. And when I say stop spending on welfare, I don't mean stop spending on, U.S. citizens. I don't mean stop spending on U.S. citizens. I mean people who are not U.S. citizens, receiving all of the, getting the payment vouchers and all the free cell phones and all the other stuff that they're getting. That's what I'm talking about when I'm saying that. Not U.S. citizens. They're not going to, no politician is going to cut money on current recipient holders. That's like when I love when the two sides try to say the other side's going to cut Social Security. I'm like, dude, it's the stupidest argument in the world. Like, neither side is going to cut Social Security, because that would be a death knell to either party. So nobody's doing that. But like I said, I think there is a lot of frivolous, just ridiculous spending in there. There's this, $2 trillion of ridiculous spending that can all be just hacked away at. It can all be cut away at. And I think they could actually get back to a balanced budget relatively quickly. The question's going to be is, if you cut taxes and you have to plug the hole there, that might lead to some deficit spending. But like I said, we'll have to, but it may lead to some deficit spending initially. But if the tax cuts spur the growth that you're looking for, see, that was the whole thing. 2017, 2018, 2019, if you go back to the first Trump presidency, he makes the tax cuts in his first year, right, in 2017, and then you see the deficit spending grow. But then what happened? Those tax cuts kicked in, and all of a sudden you saw the economy begin to take off, and then the deficit spending shrank because the economy was actually growing, and you saw the economy taking off. You saw real growth for the first time in many, many years. And as that growth went up, the deficit spending shrank. And had we not had the pandemic in 2020, I think the economy would have continued to grow, and you would have probably even got pretty close to a balanced budget by the time you got to the end of 2020. But we'll never know that because of what happened. So, but like I said, when you make those initial tax cuts, you probably will see some deficit spending. But if it spurs the kind of growth you're looking for, it could even out over time. So we'll see there. So, and I just want to go back to this real quick. So this is the ICBA 2024 election analysis. So, and I thought they had some good points in here. So what to expect in the lame duck session. So before the newly elected 119th Congress is sworn in on January 3rd, 2025, the current Congress will return to Washington on November 12th to take up unfinished year-end business in a lame duck session. The session will address the extension of government funding, which expires on December 20th. That'll be fun. Emergency relief for Hurricane Helene and Milton, and the National Defense Authorization Act for fiscal year 2025. ICBA will continue to press for priority policy changes in the remaining days. In particular, ICBA will advocate for the passage of the Farm Bill or targeted emergency relief for farmers, the Safer Banking Act, and the Home Buyers Privacy Protection Act, and an amendment to the Senate version of the NDAA. We will work to block any effort to attach the Credit Card Competition Act or detrimental stablecoins legislation to a moving legislative package. So yeah, so it could be interesting. So definitely a few dogfights there, that's for sure. What to expect in 2025? As he did in his first term, we fully expect President Trump to pursue a deregulatory and tax-cutting agenda, which could present opportunities as well as risks for community banks. President Trump campaigned on trade policy, extension of the Tax Cuts and Jobs Act, and additional targeted tax relief and stricter immigration policy. Some of these policies require legislation, and others can be accomplished through executive action. If Republicans ultimately capture the House as well as the Senate, it is likely that they will use a reconciliation process to pass a new tax bill with a majority vote rather than needing 60 votes in the Senate. If Democrats ultimately gin control of the House, reconciliation will not be an option, and the legislative environment will be constrained by divided government. What's at stake? Control of the House and Senate, their congressional leadership. What to expect? The policy agenda. The Senate Banking Committee is expected to be led by Tim Scott. There could be at least 3 open slots on the Democratic side of the Banking Committee. And then kind of like more stuff that we covered. Committee leadership in the House. Independent. Okay, so here we go. This is good. So independent leadership changes. Agency. So FDIC, Martin Gruberg, yes, maybe fired for cause. So in other words, replaceable by the president. Yes. So Martin Gruberg, I tell you, yeah, he's out. He's gone. Michael Hugh, gone. Federal Reserve Jeremy Powell, maybe. We'll see what happens. Rohit Chopra, yeah, he's toast. Gary Gensler's toast. Sandra Thompson's toast. So these people can all be fired. The only one who is technically safe is Jeremy Powell. But like you said, we don't know that Trump is really going to force anything from Jeremy Powell. Jeremy Powell's only got a year and a half left on his term, and then he's gone anyway. So, Trump might be content with just allowing him to ride it out for, another year and a half and then moving on to somebody else. But we'll see. But those other 5 individuals there are gone. History. Now, what do I think? Let me just say this real quick. What do I think is going to happen ultimately? I think you're going to see a changeover in the leadership of a lot of these regulatory agencies. A lot of the bills that are on the table, like the Basel III Endgame, I think a lot of that stuff is going to get killed. I think it's DOA right now. I'm hoping that things like open banking, some other stuff gets taken back. I'm hoping that BOI gets shut down before that gets too far down the road. People are going to have to start registering for the beneficial ownership information. They're going to have to start registering with that database with the FFIEC. If you haven't already registered, you're going to have to be registered before January 1st. So, and I'll have more information on that in other, later episodes. So, I had a lot of stuff tonight that I wanted to get to that I just did not have time to get to here. But like I said, are Republicans going to drastically reduce regulation? I don't think they will. I think that, and that's kind of one of the funny things is that it's not that Republicans don't believe in regulation. They don't believe in over regulation. And that's what, it just seems like the Democrats for the last 30 years, their thing is that when they get in there, they don't just like regulation. They want to just over regulate. They want to just like strangle the industry with regulation, and that's not like, and the part of the part of the banking industry is that, like, unfortunately, the economy, you have to have banks. You got to have banks to run the economy. That's how our economy runs and how it operates. Banks hold money and then they lend it out. That's and they hold money so that people feel safe and secure, and that if anything happens, there's FDIC insurance to protect the consumers that put their deposits and faith in the bank as a backstop. You have that's our system. That's how it works. It's worked great for a long time, and it doesn't work great though when you're strangling the banks and you're crushing a lot of the smaller banks in the country, and you're creating less and less and less banks all the time. So that doesn't help anything. But again, it's not that they're getting rid of. They're not going to come in here and like get rid of all the regulation. Like they're not going to do that. They're going to come in. They're going to get rid of some of these more ridiculous, overreaching things that are out there right now. They're going to kill off some of that. They'll change a few other things. But they're going to help to make the M&A process. They're going to stop all this nonsense, and they're going to let the M&A get back to a normal environment of just allowing deals to get done in a timely manner, without holding them up over a whole bunch of nonsense. So that's going to be a plus. That's going to be a good thing. And they're like I said, they're going to work with banks to keep banks in line, but also to allow banks to grow and to keep doing good things. So that's kind of my take on it, and we'll see. But we'll see. We'll see how all this plays out over the next couple of months. And let's see if I have, what do I got? I got a couple minutes left here. Let me just see if there is maybe a couple other things I could share with you guys real quick. Let's go here. So, like I said, Bitcoin hit 76,000, hit an all-time high this week, which was pretty crazy. Homeowners shell out a lot more in property taxes than they did in 2019. So property taxes for homeowners are up significantly across the country, thanks in large part to surging home values since the onset of the COVID-19 pandemic. Nationally, property taxes have increased nearly 30% since 2019, to a monthly median payment of $250, according to a recent analysis by Redfin. That increase comes despite the average effective tax rate across the U.S. now being 0.67%, down from 0.77% in 2019. So like I said, as housing, it's inevitable. As housing values go up, so too property taxes are going to go up. Your properties are going to get reassessed, and taxes are going to go up. TGI Fridays files for bankruptcy. So just like we had Red Lobster earlier this year, now we got TGI Fridays. Restaurants are really taking it on the chin there. So TGI Fridays, the Texas-based casual dining restaurant, has filed for bankruptcy protection, blaming issues with its capital structure and the far after effects of the COVID-19 pandemic. The privately owned chain, which has 39 restaurants in the U.S., has been grappling with competition as well as a pullback by consumers in spending amid inflation. Those restaurants, as well as locations owned by 56 independent franchisees in 41 countries, including the U.S., will stay open. The company said independent franchisees are not part of the bankruptcy. So, and I am probably going to end with that, guys. So, okay. I have a bunch of episodes. Hang on. Oh gosh, I'm sorry. I need a sip of water, guys. Okay, so I'll have a bunch of episodes coming out this week. I don't know if I'll have anything tomorrow, but I should have an episode on Sunday, and then Monday, Tuesday, Wednesday, Thursday, leading up to the next live stream next Friday night. I'm going to be I will have a special episode on what's happening with the Federal Home Loan Bank. coming out in the next couple of days. I'm working on putting the finishing touches on that now. And that should be pretty interesting. I talk about the history of the Federal Home Loan Bank, how we've kind of gotten to this point, why the Federal Housing Finance Association, which oversees the Federal Home Loan Bank, why they want to make a lot of the changes, why I don't like a lot of the changes, why a lot of the banking associations don't like the changes, and why, I'm advocating for basically like just, hey, leave them be. They're a great organization. They've worked great. They do a great thing for 100 years. And yeah, if it ain't broke, don't fix it. So keep an eye out for that. I think it's very interesting there. I have been trying to get somebody from the Federal Home Loan Bank to come on and do an interview about the whole situation. And I'm hoping that to line that up soon. That has just been timing because of politics and everything has been a little bit of an issue on that. So I'm hoping to get somebody in there soon, maybe now with the election being over, maybe in the next month or two during the lame duck session, I might be able to get somebody out there to do that, but we'll see what happens there. And I'm trying to American History series. Keep an eye out. Most likely over Thanksgiving, I'm probably going to put out the first episode in the American, not I should say the financial history series. I'll put it that way. Yeah, financial history series. I don't have the sheet with me here for a second. I got sheets with all the whole schedule and everything written out or whatever, but I forgot that I don't have it. So, but like I said, I'll get that back to everybody and then we'll go from there. But I appreciate everybody for watching. I thank you so much. And like I said, make sure to check out some of the other content on the channel. Remember that we are on YouTube, Rumble, and all major podcast platforms. Please make sure to like, share, and subscribe, as that always helps the channel. And I will be back to everybody again real soon. Have a wonderful weekend. I'll see everybody again next week. Later.